Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. Thank you as always for giving me your time. This episode features Blake Haxton of Brandywine Global Asset Management. Brandywine Global is a Franklin Templeton company. This particular conversation focuses mostly on high yield. Blake is an analyst that works with friend of the show, John McClain, and friend in real life. John and I do some man hangouts and catch up on the phone. So holler at me, John, if you want to. Anyway, I digress. I quite enjoy talking to Blake. Blake covers a bunch of, I would say, cyclical and basic materials industries. I think it's a perspective that is good to hear. And one of the questions that I've been asking myself is spreads are compressed. The front end of the curve is quite a bit higher than the back end. Why take duration? Why take risk at a time when spreads appear compressed? Why high yield as opposed to private credit? Why equity when private credit is sort of promising, or I shouldn't say promising, but if you read KKR's report, the forward projected returns are quite nice. And talking to the guys at Brandywine helped me contextualize the entire, at least in my mind, where the risks are and what may be safer and where the risks are. So anyway, I like these guys a lot. I hope that this conversation adds something to your life as well. And as always, none of this is investment advice. All of this is for entertainment purposes only. Consult a financial advisor before making investment decisions. Consider your own unique circumstances and do your own due diligence. All right, on to the episode. All right. So, ladies and gentlemen, Blake Haxton from the Brandywine Global Headquarters. Blake, how you doing today?
Yeah, I'm doing pretty well, Bill. Thanks for having me.
Yeah, you're welcome, man. Nice to chat with you the other week. And shout out to my man, John McClain, for making this happen. So thanks again for dropping by. Do you want to, I don't know if people remember the John McClain episode, but why don't you give a little bit of a background on what you do?
Yeah, sure. So I'm a credit research analyst here at Brandywine Global, and specifically I sit on the high yield team and work for John McClain and Bill Zox and Jack Parker. And we manage about $5 billion across some different strategies, all high yield credit. And they trade the portfolio and manage the portfolio, and I get to just sit and do research all day. So get to support them across the structure, and it's a great team, great place to be.
You were recently featured in Barron's. That's got to be kind of cool.
Yeah, that was a first. That was pretty neat. I
Yeah.
didn't see that one coming. That was a lot of fun. I mean, I'm sure, like I saw, I've been subscribed to the Journal and Barron's for years and years, and then you get to see yourself being. That's pretty fun.
Yeah, that would be. You send your mom a copy?
Oh yeah,
Yeah, there you go. That's necessary. Now, what exactly do you cover for those that don't know what Brandywine does and what you do within it?
yeah, absolutely. So I cover energy, transports, some basic industries, so home building, aggregates, things like that, and then I do some metals and mining as well. We have a small team, so we kind of cover the waterfront between all of us. My background, I actually started out at a prior firm, same team, but different firm, as mostly an equity analyst covering the same spaces. And then a couple years ago, came over here to Brandywine with John, Bill, and Jack to do it full time, but picked up a little bit more coverage. And those are really my areas of focus, though.
I would think that those businesses on average are better to lend to than to own the equity side of, but there are always exceptions to the rule.
There are, by and large, I would agree with you. There are certainly more opportunities, we think, to put capital to work. There are only in the equity side, you can pretty quickly choose your favorite handful, maybe. And for the most part, I mean, they're all cyclical businesses. They're all commodity type businesses for the most part. So very few buy and hold businesses in those spaces. If you get a hold of a few, they can work out really well. But to your point, generally being as capital intensive as they are and as cyclical as they are, high yield's a little bit better of a place to be an analyst because there's just more to do.
I guess when we talked, you had mentioned that you thought that like the general theme in some of your coverage is sort of supply discipline and Tightness, I don't mean to be putting words in your mouth, but is that an accurate representation of what you said, or did I make that up?
No, I think that's a pretty good summary. I mean, whenever I say that, and to your point, I think I said that regarding housing or home building, I should say, in particular, energy, certainly, mining to a certain extent, transports to a much lesser extent. We're probably going through a little bit of an overbuild in some of those industries. But no, I think you're right. We like to say, strongly held opinions revised weekly around here, because as soon as you get comfortable with management discipline and CapEx discipline, somebody's always the first guy to eat the cookie, right? I don't know if you've heard that at the old psychology experiment. I'll give you one cookie now, but if you wait half an hour, I'll give you two.
Yeah.
And the kids that wait the half an hour always seem to supposedly get better outcomes in life. So somebody always goes after it. So at the moment, looks like things are holding in there pretty well, which of course allows them to hold pricing. And in these industries, you really make your money on price. You don't make it on volume. So you want to be involved when you're on a big price upswing and supply is constrained, because that's when, from a valuation perspective, your revenue and your margin generally go the same way. They're generally pretty correlated. And if your revenue and your margin go the same way at the same time, you usually get a valuation re-rating in both directions. So if you can participate on the way up, I mean, you've got multiples on your return, and then of course you'll get, multiples on the way down. So very much we want to be paying attention to it, but we're cautiously constructive on some of these industries, where as long as we can see that discipline is holding, we're happy to be involved, and we like some of the opportunities we've got. Certainly it's not like it was in 2020 where we felt like we had opportunities all over the place. A lot of those have gone away, but to that extent, we still feel like we're able to put money to work, pretty attractive incremental returns.
You mentioned that industrials are sort of like not as tight. What would you say, just broadly, what are you covering in industrials?
Sure. So we've covered rails, trucking, and this is more transports, but to start, but rails, trucking, airlines, and then capital goods is a little bit more. I would want to be a little more specific there, because aerospace manufacturing or aggregates, or even long life producer goods are all going to be have their own flavor to them. And again, I think we could be specific. Rails, for example, they're consolidated down to, I think the cat's out of the bag. Those are pretty good businesses at this point, at least class ones valuations, I think, would hint at that. We would agree. Gross margins are incredibly strong, have been for a while. So the debate there is sort of, do you want to own it at 17 times or 25 times, and which one's worth it? And it's credit to the management teams. A lot of the capital allocation has been pretty strong. Obviously, Berkshire owns one of the class ones, so that helps. Where you contrast that with, maybe I might say, the airlines, where we obviously COVID saying it was a demand correction is an understatement, but then they came back, and I think the securities all did well on this revenge travel reopening trade, which was true to some extent, was probably never as true as the market thought there for a while. And then now I think the industry, not only has it grown, at the same time they've gotten cost pressure on the labor and fuel side, but now they're having to figure out that airline ticket pricing, get a little bit ahead of myself, but ticket pricing is really driven by patterns and seasonality, and being able to see, down to the day and the hour, what's the demand pattern going to be? And after COVID, those patterns clearly changed. I'm sure everyone listening, both of us have probably, our travel for work or pleasure is not the same, doesn't have the same cadence to it as it did before COVID. Whether it's not work remotely, you just figured out that last trip you had to take to see that client can be done on Zoom. Whatever the case may be, our patterns have changed, our habits have changed. So I think airlines are working through that. And there's more than enough capacity out there right now to do that in terms of seating capacity. And those are just not good things for the airlines. I mean, a famously capital destructive industry. And at the moment, returns are, for the legacies, for the big carriers, big three, are okay. They're not great, but they're okay. And for the low cost carriers, they're pretty poor. So there we've probably seen not as much discipline on the capital side, in spite of Airbus and Boeing's best efforts to keep planes out of the market, which has been pretty remarkable.
Yeah. The low cost carriers, they got hit more from the cost increases on the labor side, right?
Yeah, I think the answer there is they've always had a lower ability, or I think consensus has been that they have a less ability to pass through price to their consumers, which we would agree with. That's certainly true. So on a percentage basis, yeah, they're not going to be able to take pricing the way that the legacies can if prices rise. And we're seeing that. Obviously, we've also gone through some labor shortages where, if you look at the last few raises that pilots have gotten, they're really pretty substantial. I mean, that's, I remember growing up, being a pilot, especially after 9/11, was kind of a tough career to be in because my mileage flown was down, overall compensation was down, and now it's gotten tight again. So pilots are in a good spot. Again, the absolute elasticity on some of those tickets is pretty low. So really, the low cost carriers, and this is, call it the Allegiance, the Spirits, to some extent Southwest, although they're sort of in between. Their ability really depends on, hey, can we get the price low enough to cause someone to take a trip they may not otherwise have in the budget? And so and that's just a different buying decision than, you or I have a meeting in New York next week and we got to be there no matter what. So it just that demand profile has changed. And I think, that demand profile has remained the same, but the cost structure has changed. So
Yeah.
they're in a bit of a tough spot right now. Federal government, the policy being what it is, JetBlue tries to buy Spirit. That gets blocked. I think that leaves a real question mark for the future of that business model. But we'll see.
Yeah. It seems to me that like they could do a deal with Alaska and then Spirit could do a deal with Frontier, but maybe that's wrong.
It's an interesting question. I think it's a hotly debated one. I mean, with Alaska buying Hawaiian, that one may well go through. I mean, Hawaiian was in a tough spot financially, although so was Spirit. So it didn't, apparently that didn't control in that case. I think, to your point, Frontier and Spirit make a lot of sense. But to the extent that you still end up with one fewer low cost carrier, which seems to be what the judge focused on, then you might still be in trouble. I think the industry writ large says you find the same aircraft type. They're both Airbus airlines. There's a lot of synergy there. That would make a lot of sense. You sort of end up with a counterbalance to Southwest. You basically have an Airbus version of Southwest. Just to them, the market can probably handle that, and everybody's got enough returns to go around. But we'll see. I mean, at this point, why buy a carrier that's threatening bankruptcy? I mean, things have gotten so tough that we're now asking those questions. So we'll see. Really, what we're going to have to see is either a dramatic increase in demand, which, if you go back pre-COVID, demand was pretty steady, sort of up and to the right. I've talked to folks in the industry that they say their rule of thumb is GDP plus 1 or 2%. So call it 3 or 4% a year. And in any given market, you'll grow 3 or 4% a year. And if you keep ticket prices flat, it's about what you'll do. And that's not heroic demand growth, but it's not bad either. And as long as that's consistent, then I think there's probably enough to go around. But we've got to get back to some sort of equilibrium here where you can justify your cost of capital on an increasingly expensive aircraft. So we'll see. Again, cautiously constructive on that, but we see a little less discipline. Contrast that with, let's say, energy, where there's been a ton of capital flight out of the industry, either because we've had 3 downturns in the last 10 years and everyone's been burned so badly that they just don't want to go there anymore, or because the ESG considerations have just taken oil and gas off the table entirely. Then it's very hard to lend these businesses in that sense, and there just aren't many dollars floating around. So nice place to be. Like we say, I mean, the last few years, we got a big year in 2022 on oil prices. Great for energy, bad for airlines, bad for oil consumers, but it ended up plugging some holes in a few of the balance sheets that were left over that still had some question marks. So that industry has been a fantastic place to put capital to work since COVID. So we want to be choosy, and that's sort of how we like to think about it, is on a capital returns basis. Where is the CapEx going? And price for the good or the service tends to oscillate opposite to capital expenditure. And we want to be on the right side of that. Usually you have to be a little bit of a contrarian, if we can be. The high yield space does offer you those opportunities. We like to be in the new issue market if businesses are raising capital or refinancing, but we're also thrilled to be in the secondary market. I think a lot of our really good opportunities have come in the secondary market where we haven't been involved until something goes wrong, and then we can swoop in and scoop up some bonds for a pretty significant discount. And we want to be small enough that we can participate in small issues that get forgotten about. So we don't see a lot of those right now. Of course, I'm sure a lot of your listeners will know spreads are tight relative to where they have been. Total returns are still pretty good because the Fed treasuries are still offering some actual yield for the first time in many years. So I think the high yield index is somewhere around 8% yield to worst or all in right now, which is probably not a bad return. But again, some of that's because a lot of these credits the really lousy credits have migrated into the private space, and some of the larger high yield credits have been upgraded. So overall, our space is probably a little higher quality than it's been for several years. And that probably explains to some extent some of that spread tightening.
Hmm. I didn't realize that the high yield index was the total return projection was 8. That seems pretty solid.
Yeah, I mean it's not. I mean again with it
What's the
all.
duration on that?
I want to say about 3.5.
Okay.
I know
Interesting.
most of the credits are in that 3 to 4, 5 year range right now. I mean, it's an inherently short duration asset class because, of course, businesses just generally don't want to lend for that long to below investment grade businesses. We like being in the front end with the shape of the curve being what it is. We're very content to sit in 1, 2, and 3 year credits where businesses we understand. And to your point, when you're all in yields at 8, and okay, so let's say that your all in yield for it being higher up the capital structures, 7, 8, 9 in a lot of these credit cases. If you look at the shape of the curve right now, you're sort of getting paid to be in the front end on yields. And our space is an inherently short duration asset class for the most part to begin with. And if you look at like a yield to worst on, let's say, the benchmark in high yield, that's right around 8 at the moment. Well, the earnings yield on the S&P is around 4. Now, granted, again, I was an equity analyst, and to begin with, I get those are not apples to apples, and plenty of people can elucidate why that is. But it's a decent place to start. And a 4% earnings yield on equities compared with somewhere around 8 on high yield, I think you'll feel pretty decent about. I think the counter argument to that is, hey, spreads are not wide, and a lot of allocators like to see spreads blow out before they put capital to work. And by a spread blowout, we're at around 350 right now. That might be 500 or 600 is where a capital allocator sometimes want to say, hey, now we want to shift into the asset class. But again,
But then to your point, you got to tell me what goes on with rates.
well, that's exactly right. Where do you think that front end ends up, and where do you think that spreads can be? We're still able to find a lot of credits that are trading below par, which is somewhere that we like because it gives us a little bit of an extra margin of safety against our lending, which is a nice place to be, of course. And like I said, you got to take a rates view out beyond that. So from our perspective, we don't think we have to bet the farm on rates really one way or the other to get a pretty decent all-in return from here. And really, as we say, rates will impact us for sure, but we're more of a credit strategy. The name of the game for us is get paid back. Lend to businesses that return to capital. And if we do that well and consistently over time, we think we're going to be able to deliver a nice return. There are some things in high yield that we have going for us anyway. I say we as an asset class, it's one of the few that's really not terribly efficient, even to this point. I want to say it's something in the ballpark of 75% of actively managed high yield strategies beat the benchmark.
Oh, interesting.
Yeah, which I'm sure a lot of you listeners, and again, come as an equity guy at some point in life, that's got to be shocking. Where active management's a dirty word, but the fact of the matter is, as I say, not that efficient. It's not very liquid, and there's this odd function of some of these indexes where if you're a market weighted index in equities, especially recently, you've ended up just owning more and more of the best businesses. Whereas in high yield, if you again you're sort of market weighted in terms of how much debt you have outstanding, there's a chance you might end up owning more and more of the worst businesses, of
Yep.
the most levered companies. And if you can avoid a few of those, you end up really looking a lot different than the benchmark just by virtue of the fact of how the constituents
Yeah, the
shake out.
benchmark's constructed.
Yeah, exactly.
Hmm.
So active share usually ends up being pretty high across the board because, for that exact reason. And then we've also been fortunate enough to find some very small issues. And by small, I mean $300-400 million face value bonds that we were big enough to take a pretty substantial chunk of, but we're not so big that won't have an impact on the portfolio returns. And that's right the size we want to be. We will not grow to the sky here. We want to make sure that we're managing assets first and foremost for clients and for ourselves. We all have a lot of our own money in these strategies, so we want the numbers to be good. And we want to be able to take advantage of those opportunities. And we're still able to find those even in these tighter spread environments. So we like being in that space.
I remember when I talked to John, and since then, it seems to me that at least the pitch in high yield is that there is the opportunity to invest in companies like Post, maybe like Charter, where you have these companies that maybe like shorted debt at the right time, but are actually pretty solid companies. So they might screen over levered, but there's a few different, levers that they can pull. Now, I would assume that mining and oil is not exactly the same thing, but I'm curious what your views are on the quality of the underlying high yield market as opposed to maybe the connotation that high yield might bring.
Yeah, sure. That's a great question. And to answer your question, I do think that for anyone that's been a capital allocator choosing between asset classes and between security types for a while now, I do think high yield per se has gotten a little bit better. One of the big functions of that is really since the GFC, we've seen private credit come on and go from maybe not a niche asset class, but to be a huge player in the market. And that's had a few impacts. One is that a lot of the probably harder credits to lend to really we've seen go into that space. And there are a lot of reasons for that. But with the growth of private credit, a lot of the sketchier, over-levered, more difficult situations have actually ended up out of the public markets. So we just don't see them anymore. And I think that's probably been if I had to put my finger on it, that'd be the biggest driver. And I say that with some hesitation, only because granted, they're now in private credit and you don't always have the information to make those claims. It's been pointed out recently that defaults have not exactly ripped, and they're not, if you just went by the default numbers, things aren't so bad. Things look okay. That's probably about right. But on the other hand, in a lot of private credit scenarios, you don't really ever have to default depending on who the sponsor is or who the lender is. You can renegotiate, you can amend and extend, you can amend and pretend as may be the case. So the capital structures themselves and the way they're constituted from the capital markets have changed a little bit. So yeah, we do think that the underlying quality of a lot of those businesses in high yield space per se for public bonds has probably migrated up and improved. And we're able to lend to businesses that are, like you say, these maybe aren't great companies, but they're really pretty solid. And they're companies where you've got real asset values behind them. As you say, maybe you've got assets in the ground that are still essential in the industries they serve. I give you an example, and this is an area I'm more familiar with, but sort of parallels the media examples and the cable providers a little bit. Is an area where we historically didn't make as many loans was in the midstream space for oil and gas pipelines. And the reason for that was we could get better risk return offers, I should say, in the oil fields or the gas fields they were attached to. Basically, you had these pipelines that were serving these oil fields. And if you looked at the yield and the leverage on the pipeline, it wasn't quite as attractive from a return perspective as the actual oil producer they were attached to. And we thought, well, if the oil producer does poorly, then owning a bridge to nowhere doesn't really do any good. And for a while, pipelines were viewed as, this is a picks and shovels way to play oil and gas. We didn't think they were necessarily priced that way. So we, for the most part, just lent to the actual producer. That has sort of shifted recently where we've seen so much consolidation on the production side that pipelines now, although they look a little bit more levered, and certainly the balance sheets are more levered, if you just measure, let's say, EV to EBITDA to keep it simple, there are several turns more leverage, but they've also got fixed contracts with the producers, and the producers are healthy enough that we're not terribly concerned they're going to meet those commitments. So,
Yeah.
right. So to your point.
So you were initially a little bit worried about what counterparty risk or something like that? Like if they don't deliver, then who are you going to collect from?
Exactly. And for us, it was a little bit of a counterparty risk question. It was also just an outright return question because for a long time, in a zero interest rate environment, some of these pipelines, the MLPs famously, you could offer a mid-single to high single digit type return, then that was a very popular investment for a long time. and which is understandable. I'm not saying that's wrong, but it also created conditions where it was just a little too tight, where we could get low teens in the oil producer, and we had a view on that producer and that price. So on a relative basis, we thought they were a little bit too expensive for us. And again, now let's say the producers have done so well that those returns have come back, and we've seen that dynamic shift a little bit. And if you look under the hood, we still think those are pretty high quality businesses. We always would have said they were decent businesses, but for the returns that are,
Which ones? The producers or the
the pipelines.
Yeah.
Yeah,
Yeah.
what you might call infrastructure producers. And I have an aversion
Yeah,
to
well,
using
it's
the
typically take or pay, right? And you've got some fixed price or some escalators adjusted for inflation,
that's exactly right.
at least among the larger
And
ones.
that's it. And especially in this environment, you really are the low cost provider of your service. If you want to transport liquids, then having a pipeline in the ground is going to be the best way to do it. You're competing with truck and maybe rail at this point, and you're going to win on a unit basis. You're going to win every time. One way the thing you had to watch out for was how much development capex you were going to put in the ground. How many more pipes did you have to put in to sustain your production and meet your commitments? With the investment case in the US being what it is, the system is so built out at this point that I don't want to say everyone's in cash flow harvest mode, but it's sort of shifted that way from, hey, let's explore and put new lines in, to, hey, let's sit tight and be conservative and just try and manage what we've got around. That's a situation we're much more comfortable with. Of course, we don't think there's as much risk you get out over your skis doing that. And a lot of these fields, I mean, especially in the basins we've probably all heard of, the Permian, the Bakken, the Eagle Ford, yeah, they're not growing the way they used to, but they're going to be around for a long time. And like you say, on a low duration asset class, we're making 3, 4, or 5 year loans. We don't have a problem with these fields declining a lot faster than that to actually meet their commitments. So yeah, pretty attractive space to be in, all things considered right now.
Yeah. Yeah, so when you have a 3-year duration, I mean, your primary source of repayment is refi, right? Typically, and I mean, I guess it's cash flow from operations, but you're, for all intents and
No,
purposes, you're getting refied out.
yeah, that's the case. I mean, we are seeing some indications that, hey, we're going to get you'll get taken out of cash flow. A number of E&Ps we've lent to are below 1 turn, so your debt profile is below next 12 months EBITDA, and that's still a high yield business. So, which is pretty shocking when you really think about it. Or I should say, net debt. I mean, a lot of these companies have a lot of cash in the balance sheet, and they're generating cash from ops. Maybe they'll roll it. Maybe they won't. A lot of that at this point has to do with the duration of the asset itself. So when we talk
Hmm.
about duration of credit, obviously that has to do with the time and the cash flows on the loans. But with oil and gas particularly, it has to do with the payback period on the field itself. I might give you 2 extreme examples to maybe frame this up. When you frack an oil well, the rate at which oil comes back out of a well will decline, in some cases as much as 50% from year 1 to year 2. And then it trails off. It's a diminishing return where that rate of deceleration slows down over time. And then after 20, 25, 30 years, there's no more oil coming out, and you plug the well and that's it. But if you look at the math, roughly, and again, it depends on the field, it depends on the exact technique used, but you might get half of all the oil you ever get out of that well in the first 12 months after you frack it. So timing is incredibly important. Whereas, let's say we go up to Canada, which is also a place we haven't been terribly active historically, but have put a lot more money to work recently, where you have like an oil sands type field where, no kidding, they have 100 years worth of inventory. They could produce oil at the rate they're producing it right now for a century, and nothing will change. And
You know what I missed about that? I asked a buddy who was in the Permian, and I asked him, I was like, what's the deal with the Canadian assets? And he was like, they suck. And I didn't ask him the right follow-up, but I think that the reason that he said that they're not very good assets is, if you look at like the returns on capital, they're not great, but a lot of the capital is already sunk.
well,
And,
that's
and
right.
and maybe I'm wrong, right? But like, I asked somebody about CNQ. I was like, can you explain to me why so many people love CNQ and they don't, treat it like they do Occidental? Because when I look at the returns on assets on this business, they're like not particularly they don't pop off the page. And he's like, you're not thinking about the incrementals. The capital's already sunk and the reserves are super long, and it's just not going to take a whole lot of incremental capital to get the cash out of to get cash flow out of your reserves.
Well, that's right. And there's a lot. So there's a lot that goes into that right now in terms of that debate. So a couple things real quick about Canada. One, historically, and even in recent history, the differential has been a killer. Differential just being the price you get for making it in Canada, and you got to deliver it to the market.
Yeah, because you can't ship it, right?
Exactly. It's been very hard to get it out of the middle of the country. A lot of this is in Alberta. A lot of it's very far north. You can sell it in Calgary, but you got to get it to Vancouver, or you got to get it into the US, down to Oklahoma, which is where WTI is priced, or really the Gulf Coast, which is where we export from. So that differential has been anywhere between 10 up to $25 when it gets really ugly. So you can imagine, I mean, if oil is 70, which today it's around 80, but I mean, over the last few
In
years,
Canada, you got to be at 45.
exactly. So
Yeah.
if you're standing at the wellhead, so to speak, and you ask how much money you can get oil out of the ground for, it's a really low number. But then you've got all these costs on top of it. That's been a problem historically. They just opened a new pipeline into Vancouver, more or less, that helps alleviate some of that. It does two things. One, it opens up 600,000 barrels a day export capacity. So that makes a big difference. It's called the Trans Mountain Expansion. The other thing it does is it just makes production more predictable, in the sense that now you've got producers that aren't going to be hoping this pipeline opens in time and maybe risking a glut in the middle of the country. And so we think that probably tamps down some of the volatility of those differentials as well. So that's one step in the right direction. Two is that I think this gets to a much larger debate, is how long is the world going to need oil for? And one school of thought says, as I'm sure you've seen, there are some major forecasting bodies that say, well, we're at peak oil right now. They all have yet to be right, but that's what they said. My view, and we chatted about this last week, if you look at the energy use, and you can define that as calories, you can define it as joules, you can define it as barrels of oil used in the developed Western world versus everywhere else in the world. I mean, the energy distribution is so uneven, it's unbelievable. And what's going to have to happen is you're going to need an energy source that essentially helps close that gap between the developing markets and the developed world, or the developed world has to tell the developing world to bet. I mean, I want to say off the top of my head, there's 7 billion people on Earth, and 6 billion of them use less energy on a daily basis than your average refrigerator. I mean, good luck telling someone they can't have air conditioning in a car and a scooter and a refrigerator. To some extent, that's what this is going to come down to. So, and this is I realize this is a huge subject to get into, and there are a lot of different ways to.
I think it's kind of interesting that at the same time we'd have to tell them not to have a refrigerator. We don't mind just plowing money into AI, which apparently, I mean, I'm going to mess up the stat, but like one GPU uses, somebody else look it up, but it's like many houses worth of energy in a year is what a GPU uses or whatever.
I mean,
I think it's crazy. The juxtaposition of we are on the edge of a climate crisis that must be stopped, but also we need to go after AI full blast is like something that makes my head spin a little.
It does. And I think if you look historically, we never really transition off of energy. We just add new sources of energy as a species.
Yeah.
Like we never really got away from coal, so to speak. We did in certain local markets. If the US uses less coal because we found shale gas and it's a lot cheaper, it makes a lot of sense. But the world still burns a lot of coal. We just keep using more and more energy from different sources. Unless and until something dramatically changes, I think that's probably a decent bet. And to give you an idea, I mean, some of these businesses trade in the single digit multiples anyway of earnings. And this is real earnings now. This isn't, adjusted, EBITDA where you're trying to, cheat. I mean, this is actual cash flow. So you flip that upside down and say, okay, I've got, in less than 10 years, I'm getting all my money back at these prices. And, do you think we're going to need oil in 10 years? I mean, I think the answer is yes. We'll be paying attention to that, but I think the answer is yes. And not to say that other sources won't grow as well. We think there's a place for renewables. We think there's a place for really every kind of energy we can create, there's going to be a place for. We'll find a way to use it. That's one thing humans are very, very good at. But needless to say, we don't think that the duration of these assets is matching up with the duration that some investors are taking on them. And we think that provides a bit of an opportunity.
I mean, the easy answer is ESG, but I'm conflicted as to whether or not I think that's the actual answer. I mean, part of me thinks that there's so much money flowing to chasing assets that are going a lot higher in price consistently, that why mess around with sort of these cheaper assets that, historically somebody ends up cheating and the market gets all messed up. And maybe you think your PE is 15 but your actual duration, or 7 but your actual duration is closer to 15 or something.
I think
i i,
I think you're
I think
right.
that's probably close to reality. I don't know.
Like as as somebody that spends most of his time in energy or energy intensive investments, there are plenty of people that want to use ESG to explain the underperformance at different times. I think that is too simple, to your point. I mean, one simple fact is this industry has been a terrible place to put money to work until very recently. I mean,
Yeah.
yeah, it was the place to be in some respects from, '05 to '08. People made a lot of money. Obviously, the fracking revolution totally changed the dynamic of the market. We've had several downturns, both supply and demand driven in the last 10 years. COVID sort of put a floor in, which negative 40 is a heck of a floor. And and then
Yeah.
sure, the returns since then have been really, really good off of an incredibly low base. But it's also hard for me to look around and say, hey, how many times do you have to be bitten before you shy? And there are plenty of portfolio managers that would tell you, okay, after the third downturn in 5 years, we'd had enough. And
Yeah.
that explains a lot. I mean, I think I want to say in 2020, oil, or these numbers won't be exactly right, but oil made up a tremendous portion or energy writ large was something like 20 or 30% of the S&P in 2008. And I want to say in
Yeah.
2020 it got down to 2% at the low. I mean, it just didn't play the same role in the economy, at least on a pricing basis. So part of it was you didn't have to have an opinion on energy. I mean, it used to be absolutely crucial that every fund and every allocator had to have an opinion on what was going to happen to oil prices. And then that went away for a while. That may be coming back. I think the Russia-Ukraine war has brought a lot more of that back into focus, where people sort of ask, okay, one question we need to ask is what's the break-even price that clears the market? And that's one level of analysis. That's a hard question to answer, but that's one question. The other question is, okay, given some geopolitical event, how high could it go? And if we don't have a position in some of those securities, at least from a, for lack of a better word, insurance perspective, how do we need to allocate to make sure we're not on the outside looking in? I think 2022 is a prime example of that.
This is the conversation that I've had with myself a little bit, and it's 2 years late. And my man Jake would probably tell me a year and a half ago that I should have. Well, he did tell me multiple times, and I didn't listen. But yeah, I know that we're sort of like past this is the '70s redux narrative, but what if we're not? Like
It's
I
it's
don't know that I want to like have an all on bet that we're not past the '70s, or even if we're not past the '70s, if 80 really is the new 60, some of these things are going to work pretty nicely, and I don't know what the rest of the world will look like.
well, that's you're right. That is the debate. And that is the question. I have to repeat myself. I say cautiously constructive. Part of that constructive is when we look at who we think the swing producers are, and let's just broadly define that as American shale CEOs and OPEC energy secretaries, because those are the decision makers that really control the market at this point. And let's try and ignore what they say and just watch what they do. Within recent history, we've seen oil go back down to the low 70s, 60s neighborhood. And by and large, those two groups both pulled back, and we saw that happen. Right? We saw rig counts come down. We've seen consolidation. We've seen capital not flow back into the industry, and we've seen OPEC ministers. And this has been expounded on any number of podcasts, so I won't get into it. But it looks like they want oil somewhere in the 80s or 90s in order to be able to clear their budgets to make their commit. Saudi famously is now investing a lot in Vision 2030. Russia's fighting a war. So there's good reason to think that they want to put a floor under prices. Whether or not they have the wherewithal and the ability to do that is a different hotly debated question. But having said that, we've got a huge portion of the cost curve that seems pretty sensitive to that $60, $70 a barrel range. So, okay, we can underwrite a lot of these businesses that are in the market today at that price. And we're not going to make the kind of returns that were available in 2020, but these are still pretty competitive investments. So to your point on, okay, do I want to go all in on this? My words, not yours. I'm stealing them from some commentators, but in sort of a new super cycle thesis in energy, you want to go all in on that? Or do you want to say, no, this time's different. We're all done using oil. I mean, I think the answer is certainly somewhere in the middle. But having said that, you can take some of that risk. You can take risk in a pretty cost efficient way right now, would be the way I would say it. And if we're sitting here in 5 or 10 years and either of those things come to fruition, I don't think you're going to regret having put some capital to work there, whether or not we do see a tremendous rip in prices, or we just see things sort of peter out and basically everybody earns their cost of capital over a long term, which is what textbook would say will happen. You'll earn a decent return either way, and you will have taken some serious risk off the table. We're all consumers of energy in any number of ways. So I do like having some of my own exposure in that just because it provides a hedge to my own lifestyle. I've told my parents the same thing. It seems like pretty good advice to stick to. So at this point where valuations are, it's not a real stretch to try and get some of that exposure. You don't have to have a strong opinion, is what I'm trying to say. There are a lot of ways this can work out where you still earn a pretty decent return and you've protected yourself from a real tail risk in that.
Yeah. I guess, circling back to to earlier in the conversation, you had said like the equity yield is, call it 4%, and high yield total return expectations are around 8. I think what's interesting is like there's this issue, right, where some of the more quality names in equities, I think are I understand why. Like when I hear 30 PE, I think of like a longer duration asset, right? Like I don't think of it as, and maybe that's wrong to think that way, but I think of it as like long duration. And I guess that I the people that are paying that are comfortable with the growth that's on the come, but should somebody decide that that is actually probably not worth taking that much duration, you're going to need to live through a lot of growth, and that growth has to happen. Whereas maybe the upside is not there, right? Like maybe 8% is not sufficient, but, and I guess on the 8, if you're only taking 3 years, you have more reinvestment risk, but something seems wacky to me right now about the way that things are priced. And I guess I would have always said that. I don't understand how certain things are priced right now, and I probably never will. And that's probably why I should outsource some decisions to the market. But there's just something's odd about the difference in the way that certain things are trading. I mean, even private credit, like I think that's where the junk of yesteryear used to live. I think everyone can agree that's sort of like the junkier, more levered credits. But and it's incestuous, and I've got plenty of issues with it. But like what I can't get over is if you don't like private credit, how do you like private equity? Because like to me, that like private equity is like way riskier than private credit, and at least in the private credit landscape, you hope if multiples get cut by 30% or so, there's still some asset value there for you. Where
Yeah,
the
I
equity,
mean,
you really only have one way out,
well,
unless I don't see the ball clearly, which is possible.
no, I mean, I this is easy to say. I've always been in the public markets, so again, easy for a guy that's to beat up somebody
That gets
else's
marks.
book, right? Yeah. I mean, to your point, I think listening to some of the people that seem to know what they're doing there, and even seeing the deals that come our way in the public markets and how they are valued relatively,
and I hate to say this, but it does seem like there really is a economy of scale isn't quite the right description maybe, but you really want to pick your manager very, very carefully, right?
Yeah.
The private managers that do a great job are going to do a great job. They get access to the right deals. They've got enough powder to make the transaction happen. They can be creative on the balance sheet, which is something that I'm loath to say, but the fact of the matter is they can. They've understood that after all the regulation that came in, a lot of this debt that used to be on bank balance sheets, and it's, again, I'm loath to say this, but is probably better off being in the private markets than being on bank balance sheets for reasons of liquidity, because speed of transaction, because of who can underwrite the risk, reasons of clarity, all those things. They really probably are better off being in the private space in general. But, if you don't have a manager that knows what they're doing, to your point, maybe that downside's a lot lower than investors think it to be. I've heard a number of private equity and private debt managers recently in the media say things like, well, we're getting superior yields for less risk. I mean, I'm not looking at their
That's
deals, so I can't
that's
say.
a beautiful thing. Could you imagine? I've never
Right.
seen it in finance.
Right. And I'm a dyed-in-the-wool value investor, and I do believe that opportunity and risk are not always opposites. But I think that to the extent it's true, it probably won't be true for very long.
Yeah.
And when it ceases to be true, it will probably cease suddenly and painfully.
I
And
like how you said that.
thank you. Maybe that's our sales pitch for why you ought to be in public bonds, so to speak. But one of the reasons that we do like the public bond space is there is a lot of disclosure, and it's a well trafficked asset class at this point. It's a couple generations older than some of the private credit vintages in that way. So we think there's there's a lot of history here to lean on, which is nice. Maybe a false sense of security, but it's a sense of security nonetheless. And like you say, superior returns for less risk. It's just the type of thing that's true until it isn't. And man, when it isn't, it shows up all of a sudden. So I
Yeah.
think we share your concerns. I'm not going to sit over here and say that the whole asset class is a waste of time. I don't think that's true at all. I think there are going to be some managers that put up some
Oh, I
excellent
don't.
returns.
Yeah.
Uh,
I don't even think that either. I guess what I really scratch my head at is how equities are trading. However, every single bull market climbs a wall of worry and naysayers. So my having this feeling probably means the bull has a lot further to run.
That's well said. I'm sure you've seen the same thing. If you look at the distribution of returns in equities so far, even this year, it's like you owned some of the AI oriented names, or you haven't done terribly well. Um, and maybe that's right, maybe it isn't. But by the same token, and here I am talking about a 4% earnings yield in the S&P. If you go down the capital structure a little bit and say, let's look at some mid caps, let's look at some small caps, let's go Russell 2 value. Those valuations seem a lot more reasonable to me. And part of the reason I say that is those type of businesses are usually the ones you see that issue high yield debt, right? They're nobody's favorite. They're capital intensive. They're cyclical, but they're usually been around for a long time. And they provide a good or a service that's essential to the economy, right? Air travel, energy, so on and so forth. So when you look at the multiples on those companies, those look a lot more reasonable to me. Those are, in some cases, high singles, low teens type multiples, much closer to historic norms. And the debate there is, all right, well, if you're heading into a recession, these are not typically companies you want to own. Most people will tell you that. Are we or aren't we? Is really the battleground there. But the multiples seem to suggest that it's battleground, and the multiple is about where it should be, given that we don't have agreement on where the next cycle is going to start or where it's going to go. And of course, your opinion on rates is going to influence what you think that rate multiple is going to be over a long period of time. So that's another layer to it. But regardless, in some industries, like I say, I think that the capital allocation has gotten a lot better, and you can actually put capital to work. Given you've got a long time horizon, I mean, in the short run, I've never been terribly good at the short run, so it's easier to just say I don't want to play that game. But we think in the short run, again, like it could go any direction. Long run, we think there are some pretty reasonable opportunities out there. So I mean, we're seeing that. We're seeing it in the high yield space. Even, sometimes we see things go wrong a little bit before the equity markets do. Again, I think the market, to your point, is climbing a wall of worry almost in spite of itself. I mean, I've been reading reports about housing inventory is going up and new home sales are declining, and now there's a lot of home sales going unsold. But what they don't, which is true, but what they don't tell you is that inventories and
All-time low. Yeah, it's growing off of like the lowest base.
yeah, exactly, they're not back to 2019 levels yet.
Yeah, that's crazy.
Right. We've seen rates go up, several hundred basis points, and mortgages go up several hundred basis points, and yet we really haven't normalized yet. It doesn't look like it to me in terms of those inventory numbers. And to the extent we have, it's not extreme. So, and nonetheless, housing prices have yet to correct massively. So, okay, maybe there's a lot to be said for this. The crash is coming, and I know that gets clicks, but we haven't quite seen it yet. And I always take a lot of comfort in how worried the market seems to be, right? I mean, greedy when others are fearful, fearful when others are greedy. I'm not saying by no means now is the time to be greedy. I don't think that's our view. But
At the end of the day, like we said to begin with, on the credit side, you do have to understand the business, and you got to know the name, and you got to understand how management thinks, and you want to understand the cash flows on a 3-statement basis. And that sounds oversimplified, but it's important. And especially in fixed income, it's very easy to focus on the big levers and forget that you're lending to individual companies that actually have to go out and operate in the economy. And I think when we look at a portfolio on that basis, we feel a lot more comfortable making decisions and assessing risk than, to your point, all these very important high level questions that are worth discussing. But if we're trying to put together a portfolio to earn a return, we all have to go home at night and be accountable to our families on what we put them in. Then I think our view shifts, and we think that the risk reward is still pretty attractive on an all-in basis.
Well, I don't know what else you do. It's not like you're not going to get out of the market. That makes no sense. I guess it seems to me that the pitch on private, and not to go back to private credit, but I think the pitch on private credit is if they can deliver, 10 to 12 or whatever percent, why would you own equity? And I almost wonder if it's not the similar pitch as it pertains to debt generally. I mean, if you really, I guess on an after-tax basis, 8 turns into what, 5.5 or 6 or so. But still, that's not like a terrible return historically, as long as you can reinvest at that.
Well, that's, I mean, you hit the nail on the head. And yeah, certainly a lot of this in fixed income world is contingent on your own tax implications because, obviously you want to try and avoid the income hit for a lot of people. But I see it exactly the same way. I mean, if you can get, some of these target IRRs are 12 to 15% through the cycle. And if you can get 12 to 15% in a debt instrument, then you don't really need to own much else. That's going to meet just about everyone else's investing goals. And if it doesn't, then your goals are probably not realistic, which, to your point, makes me suspicious that those numbers are not right over a full cycle, throughout the duration of an investment lifetime. Like say, to the extent it's right, it won't be right for long. So maybe you can participate early and get a big rip. To hear the private equity allocators tell it, they think the market can continue to grow and it's got a lot of green pasture still. Hey, maybe. Not my.
I hope it's true. If it's true, we're all going to be in great shape.
Oh, right. If it's truly a better way to, if it helps the capital markets function and delivers great returns to people that understand and can underwrite the risk, that's all any of us are really trying to do, right? And hey, at the end of the day, it might also take some volatility out of the banking system and the financial system writ large by marrying the risk to people that are, understand it and can allocate accordingly. That's also I think one of the arguments that's been made for the last, call it 15 years, is that it's a better way for capital to flow through the system. And I think there's a lot to that argument. So, like I say, I'm not rooting against anybody, but when you see some of those returns be that good for that long, it makes me worry a little bit.
Yeah. Wait, let's get back to housing real quick, because I don't know that we closed that loop. So like what's your version of reality when it comes to where we are from a housing perspective?
No.
Because I mean, it's been interesting these past couple months. A lot of these stocks have rolled over. And I think the debate is, are margins going to collapse? And how sustainable is the current building pace? And are we going to have to slow down? And I'm kind of curious to hear you riff on it.
Yeah, sure. And that's a great place to start. I think some of the equities have rolled over. We've seen in Florida, to me, stands out, where the builder surveys, builders are saying that there's some weakness in the market and they're starting to get a little concerned, which makes sense given how strong the market's been since 2020 down there.
Yeah, man, they built so much.
They just built a ton, and I know now they're fighting with, I'm sitting here in Columbus, Ohio, so very, very different view of the world locally. Obviously, insurance down there, insurance costs have spiked, so that's creating another bit of angst. And okay, great. Now we've got higher mortgages that are starting to work their way through the system, and we've got higher insurance rates, So the carrying cost of a home in some of these markets is going up, and that's something to pay attention
A
to.
lot.
That being said, I think it's something like 40% of homes or single family homes don't have a mortgage today.
Really?
It's a very high number. And
wow, that is high.
And when you think about, I think there are several reasons for that. One is you've had baby boomers and really up to Gen X have lived through the greatest period of wealth creation in the history of the world. And it's been broad based in the US, and home prices have gone up basically 3x since 1990, give or take. So that's a pretty great way to get out from under a 30-year mortgage. And I think a lot of people are now having this conversation with their parents or grandparents even, saying, "Hey, I appreciate you want to downsize, but you don't have any debt on this house. What are you doing that for?" And I think a lot of people are retiring in place. A lot of people are like where they're at, and that's a factor. I think. And I'm talking about, of course, what's going to be strong in the housing market. I think an under-discussed issue at the moment is we're starting to see what will be the greatest transfer of wealth between generations in history.
Yes.
Right? From retirees into, my generation and iGen, or whatever we're calling what's coming next. And a lot of that is coming in the way of down payments on houses. And and I'm skeptical that the numbers on this are really, really clear, but there's a lot of help on first-time homeowners from older generations. That's another way in which you're keeping debt at a manageable level. So all that rolls up to, the last piece I would say is we've still had a lot of immigration in the United States over the last 30 years. So you have more people and more wealth to go around, and the housing stock does not look like it's kept up. Obviously, that number really hasn't kept up since 08, 09. It's recent history there where numbers haven't gone through the system. And now that we're seeing some really strong demand, especially for new homes, I want to say the average home in the United States, and I might get this a little wrong, it's around 30 or 40 years. I want to say it's almost 40 years.
That's
right?
what I thought it was.
The housing stock is aging, and demand for new homes should be pretty strong. We now have a generation. My generation. I'm sitting here, 33 years old. I graduated high school in 2009, and nobody wanted to go into the trades. All the trades were out of work. You just couldn't get employment there, and so you had a generation. Like I say, that their labor market. There's this pocket in the labor market where it was very hard to get skilled work. And now, obviously, the demand for that's been very strong. I think it's gratifying now to see young kids considering maybe that instead of college or higher education, where maybe that bill's not exactly worth it, but that's a whole different discussion. Anyway, there you go. There's your supply constraint. So looking at it from the builder's perspective, it's a volatile time, but I think it shakes out where builders can still earn a pretty nice return on their assets. And accounting for home building inventory, because of the way you have to account for land and work in progress inventory, is a little weird. But if you look at balance sheets for home builders, they're really pretty strong, even the ones that have debt on them. And back to industries that have learned their lesson, home building, I think, is right near the front of the pack in terms of what were management teams doing that blew up in 08, 09. And this is the classic, Charlie Munger, just tell me where I die so I don't ever go there again. You get management teams that say, we're not going to take on a lot of debt to buy a bunch of land where we're not actively building homes for sale, because that's how you blow up. Famously, NVR is a home builder that, that stock chart is incredible if you want to look at it over the last 30 years. They had a model where they optioned all their land and could let those options expire. Yeah, higher upfront costs, sure, but they could let the options expire in a downturn and didn't get stuck with a lot of expensive inventory on the balance sheet. And we've seen a number of home builders copy that style in one way or another. Maybe they each have a little bit of a different flavor to it, but that's become much more common. And so to the extent we are in a slowdown, which certainly going from 22 to 23, when rates really climbed, we saw home sales decelerate and home building decelerate. To the extent that continues, the businesses themselves still seem reasonably priced and probably earn a reasonable return over a long period of time. We've participated in a number of homeowners credits over the last year that have been nice returns for us. These are home builders that do not want to get over leveraged. Every conversation is, I would say, a fearful conversation. Back to our discussion earlier, all the questions from investors are, how manageable is your leverage? What's your cash flow like? What's your interest coverage like? I mean, that's a question that a lot of management teams haven't had to ask for a while. And for a while, I mean, okay, in a zero interest rate environment, the discussion was, hey, net debt to EBITDA, what's your coverage? Can we get paid back on the face value? Not on a cash flow basis, can we cover the interest going out the door? Because you had, mid to low single digit interest rates. Well, to your point about private credit, now you've got companies printing low teens interest rates, and that kind of coverage is now a much more active discussion. But as it relates to home building, be remiss not to say, the old cliche about location, location, location. That's certainly the case. The markets that have done well, the Midwest, I'm sitting here in Ohio, we've grown nicely. Not gangbusters necessarily, but there's been demand to soak up the supply. And if anything, I'd say demand's outpace supply a little bit. Certain markets where people still want to be. I mean, it's easier, as much as the Buckeye in me would love to just take a swing at, California in the Pac-10. People still, when you poll young people and they say, if money was no object, where would you want to live? People still say Southern California and New York. And I don't think that's going to change in a tremendous way. We've seen some shifts here for cost of living and other things, but at the end of the day, the ability to put new inventory in those markets is still going to be a pretty good investment to the extent you can make it happen. So all of that is to say, I know I've given you the just rampant both sidedism here, but we're looking at gross margins for home builders in the mid to high teens and return on assets in the teens for relatively low inventory and very manageable leverage from our perspective. And these are equities that trade at high single, low double digit type multiples. Okay. And I like I say, you tend to make more money in these industries on price than you do on volume. So I like to see where are some uncontrollable supply constraints. And I mean uncontrollable from the perspective of management. And if you don't have enough labor and you don't have enough supply chain to get out from under the demand, then I like that, because you're not as prone to bad actors, coming in and oversupplying the market.
Yeah, they almost can't, right?
That's exactly right. I mean, you talk to home builders, as an example. This is another one where having some scale really does make a difference. You ask home builders, hey, how many homes do you want to build in the market? And they'll say, well, as many as we can sell, but we want to make sure we build just enough to keep our trades employed. Because the tradesmen will say, well, hey, as long as you can keep me employed and give me work, then
I'm not going to look elsewhere.
That's exactly right. So, okay, what does that look like? Well, in a given city, maybe that looks like 2 or 3 communities at an absorption rate of a couple houses a month. How many houses out of that community get sold every month or every year? Well, great. At that pace, the market can probably absorb it. We can keep our trades employed, and you don't have much of a problem. Some of the really small builders that want to do a house or 2 at a time, and they might have their favorite electrician, plumber, you name it, come in. Well, you're at the back of the line. So to your point, there's a, for the time being, at least, there seems to be a meaningful but not deadly supply constraint that is keeping the market from going gangbusters. And so long as that will, just like anything else, that will mean revert over time. That'll work its way through the system. But for the time being. It seems like it's sort of a sticky issue. And as long as that's true, we think that, capital is going to be able to earn a nice return. So
Yeah.
now there's also a discussion there about, which I think is kind of interesting, around, how much does home price and building costs impact the inflation discussion, which then impacts your rate discussion, which impacts your mortgage discussion. And now you've got the same issue on both sides of the housing debate. That's clear as mud right now, because anybody looking at building supply, we were chatting the other week, lumber prices have come back down tremendously from the squeeze we saw in 2020. But at these prices, mills aren't making a lot of money. So we would think that price probably reverts a little bit. All right, well, how sticky is that? To me, it looks like there will be some cost push through out into the future. I mean, hopefully they can wring some efficiencies out of it. I know people, depending on who you talk to, will say we basically build a house the way we did 30 years ago. Some of the materials are a little more advanced, or a little more energy efficient, this, that, or the other. But until we see a big breakthrough there, then those numbers probably don't change very much. So anyways, trying to put a point on it, it's an incredibly dynamic situation from both the supply and the demand side nationally. I think you can get a much better feel in certain local markets. And when it comes to the home builders that are big enough to have public securities out there, either debt or equity, then it seems like you're paying a fair price for the landscape that you're approaching right now. So again, probably a decent place to have some capital to put to work.
Yeah. And maybe this is an impossible question to answer without actual specific examples, but how do you think about going down on the credit quality to get a little bit more yield? All else equal, would you be more biased on a little less yield for a little higher credit quality? Or this is an impossible question to frame the way I'm asking.
No, it's a very important question. I mean, look, let me tell you my bias. And like you say, we got, I'm going to say this, and I can just feel John McClane and Bill Zox cringe as I say this. There's nothing more attractive to me as a dyed-in-the-wool value guy than a nice high coupon and a really high yield. And I'm thinking, hey, I'm going to earn teens and get paid back. This is going to be great.
Yeah.
I think when we get investments like that, we all start fantasizing in our head, okay, how many of these do I need before I don't even need to, I can replace my income.
Yeah.
I'm a sucker for that. I've learned my lesson. I've gotten my hand caught in the cookie jar a couple times, and that is just a painful lesson that you don't want to learn twice. A couple things. I think the lesson there is really, and in high yield, I think this is even more true in high yield than it is in equities, to be honest with you, because equities, there can be so much emotion in it that sometimes you get an equity price that, in my opinion, doesn't have the information quality that you think it does. Maybe the market's short term, maybe there's something technically going on, who knows? My view is that doesn't happen as much in high yield credit. If something is priced wide to a similar bond and you're looking at the comparables and something's weird, chances are very, very good there's a reason for it. So here's I can give you an example. A lot of our Canadian credits for oil and gas, there was a credit, and I don't want to get into specifics, but there was a company we lent to last fall that printed a 12% coupon and came to market for the first time. And at the time, interest rate or the yields were really high singles for energy. But your antenna goes up. Like, okay, this is several hundred basis points more yield than is being offered in the market for similar sized businesses. Like, my gut reaction is to say we're going to pass, because if that's what it takes to get this deal done, there's probably a good reason.
Yeah, why?
Exactly. We want to be able to know exactly why that's happening. And in that case, back to our earlier discussion, there were several things we could look at that we felt like we had a good handle on why the market was looking at it the way it was and why that was incorrect. And so to try and answer your question on, do you want a little higher quality, a little less yield, a little more quality? The short answer is that's a portfolio management question that really has to come out as you construct the overall portfolio, and is above my pay grade. So how to answer it like that. Having said that, to the extent you find something that has more yield for a lower credit quality, it's very, very important to have a much sharper view of why you are divergent from the market. And to the extent you can do that, we're thrilled. I mean, as an analyst, that's my Super Bowl. Can I find a credit can we find a mispriced credit that performs the way we want it to, and is really added to the overall portfolio in a meaningful way. That's what we're looking for every day. I wouldn't put a percentage on it in terms of opportunities we look at and pass on. The vast majority of things that have these really high yields, we're going to pass on because they're cheap for a reason, right? So I would say that the credit quality and the yield, we want it to vary inversely with our confidence. Give you an example on the other side. 2 fallen angels that have since been upgraded, Occidental Petroleum and Ford Motor. Well, I've covered those businesses for a while. Not a lot of secrets. Yeah, we can debate the quality of the overall oil market or the overall automobile market in the US. Hey, fine. But at the end of the day, these are really understood credits, and we know why they're doing what they're doing. We don't need to go hunt for specifics around the deal. Those, again, really since been upgraded to a very low IG, but been upgraded. Okay, that's fine. Those are well understood. Those are very liquid. No big deal. The other thing I would say on this point is it's not just the yield we want to pay attention to or the coupon, it's the liquidity. And this is something that I've had to come a long way on learning, because these guys grew up in the credit markets and the teams grew up in the credit markets, and I grew up in the equity markets. And in equities, even small cap equities, you're used to being pretty liquid. If you're a long-term holder, just being able to get a position, unless you're in a really massive fund, is generally not that hard. And certainly if you're an individual investor, it's almost never a consideration, right? High yield credit just does not work that way. And this ties back into how we were saying it's a less efficient asset class. There are issues, $200, $300 million face value that might trade a couple times a week if you're lucky. And the spread on the bid-ask spread might be whole percentage points. On stocks, you're used to the spread being a couple pennies, maybe, right? And understanding where those credits are priced and being able to be in the seat and see, okay, these bid and ask prices are skewed from where they can be. You can essentially demand a liquidity premium from the market on both the bid and the ask side if you know what you're looking at. And so that's so every credit we get involved in, that's a piece of the discussion, is how much of this do we want? How liquid will it be? Can we take advantage of the liquidity dynamics in the market? Because if we can't, there's going to be a return premium we can get somewhere else. And I'm trying to answer the question you originally asked, which was, higher credit, lower yield, or lower quality, higher yield, Something that's important to understand is the way the ETFs and the way passive has impacted this market. Forgive me for jumping around, but it speaks exactly to this liquidity issue, because in the equity market, passive has famously taken over. It's very hard to beat the passive benchmark, and there's a very good passive benchmark. You can go out and get, the S&P 500 ETFs, and that's great. You're paying a couple basis points, if that. I think a couple of them are at zero now, right? Because they make revenue the other way. What happens in the high yield space is the high yield ETFs, people want to use them tactically to get exposure to the asset class as a whole, which is really a spread and rate bet. And there's something to be said for that. But practically what happens is that a whole lot of capital moves into one of those ETFs. The ETF has to go out and buy a little bit of every issue in the market that's in that benchmark, or at least it tries to. Well, if you get down the face value structure and down the market value structure into the really small bonds that are really illiquid, that is I won't say it's a price agnostic bidder, but it's close. It's a price insensitive bidder on that particular credit that maybe they just want to put money to work, and you can exact the premium because they want to get involved. And then it works the same way on the sell. They pull a bunch of money out. All of a sudden you have a buyer or a seller that's not really selling based on price, which is a great place to be on the other side of the transaction. So those are all factors we want to keep in mind as we look at this. First and foremost, we're always going to be business analysts, and we're always going to look at it from the bottom up, and can we get paid back? That's the most important thing. But there are these secondary considerations in our market where we want to be aware of how those things work, because that is going to impact our total return and the way we put the portfolio together. So I know I really bounced around on you here, but
no, that makes sense.
Your questions.
I was trying to ask you a question that would have you talk like this.
Perfect.
So I'm glad that you're talking like this.
It's a great question. It's a very perceptive question, because even though we've all been doing this for, our teams work together for The four of us, almost 10 years, exactly, just about 10 years we've known each other, worked together in all kinds of different capacities. This exact discussion is still the one we have sitting around the office. We all sit within, we're all in the office every day and we sit within arm's reach of each other. And when a credit comes up, we're going to tick all of these boxes because any one of these could just subtly shift the dynamic of what's going on. And that's why this job is kind of fun. It's not kind of fun, it's a lot of fun. And it's also where you feel like you can really add a lot of value as an active manager by having an opinion and understanding how to interact with the market, as opposed to, hey, I've got this view of oil prices and I've got this view of gas and I've got, here's what I think home builders are going to do. Those are fun puzzles to try and solve. But then when it comes to the tactics of how do you express that opinion, I mean, that is also a very important part of how you put the strategy together. So it's a very technical asset class in that sense. And it's very important to put all those facets together, or else you might be leaving some real money on the table. And these returns, like I say, these can be several hundred basis points at a time. So this is meaningful, this is meaningful return prospects that we just want to make sure we have an eye on and have a view on. So I think you can also tell in this discussion in the beginning when I said, hey, I'm a research analyst. I don't trade the portfolio and I don't manage the portfolio as PM. And I love my role because I try and present the business from the bottom up and answer all the questions that, hey, we've discussed about this home builder, that home builder, this oil producer, in a way that it's easily digestible by these guys that have to sit there and say, okay, when do we pull the trigger to buy or sell? And I have to have all that in mind. And then I have to interface with the market and understand how this particular security is trading. You have to marry those views. And every iteration, we think every forecast is just an iteration about the future where you're trying to be a little less wrong. Right? I mean, no one's going to be right specifically. Over time, as we've iterated through that, I think we've gotten better at it. And you do, right? I mean, after you've had a conversation about a company for the 10th time, you sort of know how the other guy is going to react, which is great. It feels like a sport sometimes where the team, the whole is greater than some of the parts because you can really work through things very quickly. We're going to have an opinion on a credit pretty fast. And if we don't, we're willing to say, there are plenty of things we're just going to put in the too hard bucket that, I'm just going to say, hey, I'm not really fit to have an opinion. I don't care how good of a return prospect it looks like. I will pass because that's not in our circle of competence. There are also places where we can get up to speed really, really quickly. And that's a lot of fun too. It's a very additive discussion. You feel like you can improve over time.
Yeah, I'd imagine. I mean, everything is a get your money back issue, but I think debt particularly is because you don't have the right side to bail you out, right? There's never like some huge winner in debt, right? You just get your money back and move on.
That's exactly right. Well, it's like Howard Marks, I think I would imagine the Marx memos is a gateway to a lot of young people in college and afterwards into credit. And it's a great place to start, but he calls the famous loser's game, right? It's a negative art. In credit, it's about what you don't own. And as long as you don't own the things that default, you're going to put together a pretty good track record. I mean, that is the game. In equity, to your point, one home run in the portfolio can cover all kinds of mistakes. And a lot of great track records of history have been made that way. Credit, it's the exact opposite. The best you can do when you make the investment. Now, I will say, in the spirit of being in covering all bases, every once in a while, and especially in the high yield market, you will get a chance to swing for a really nice return. 2020 was that for us, where we were buying bonds at 30 or 40 cents on the dollar that ended up earning, high double-digit returns because they were just mispriced. You have price insensitive buyers, particularly in the high yield market, when things get ugly. Holders can be very, they don't. There are certain players, even in high yield, that just don't want to hold bonds if things get really, really ugly. And certainly March and April of 2020 was one of those times. And certainly in my industries of airlines, oil and gas, you name it.
Yeah.
Right. I mean, that was there was plenty that was going wrong all at once, but there was a lot to do there. And all of a sudden you go from seeing high single digit type yields to 20, 30% type yields to maturity and say, okay, the game has changed. Now, we're not really in a pricing game, we're in a survival game. And how do we want to do that? And we had a view on some things. We had a view on some things ahead of time that allowed us to have an opinion really quickly. And that was really, really fun.
I am not a distressed analyst per se. It's a very narrow skill set. John started out in distressed and has done that and has a lot of understand how that system works. I am not the guy to ask there. We also like to say, distressed happens all at once, and then you go for long periods where there's not a lot to do. It's because the way cycles work. So, do you want to? Is that the type of thing you want to do as a career, or you can build a strategy around? Yeah, it's tough. It's tough. So that's probably that's a little bit of a different
Nice
thing.
tool to have, but maybe not the strategy to run.
Exactly. Hey, it's great. It's a nice to have. And there's nothing better than owning quality when something you like falls out of bed and then you go trade into it. I mean, that's sort of like the dyed in the wool Graham Dodd value investing, where, hey, I'm buying, maybe I'm not buying dollars, but I'm buying, 3/4 for a dime type thing. I mean, that's pretty fun. So it's an element of it. It's an element of the high yield market. It's probably going to be less than it was going. It's probably going to be less going forward than it has been in the past. Back to our discussion around private credit. A lot of those credits are probably going to go through workouts and amendments and capital infusions in a subtly different way than they have in the past. So I would anticipate that, even though definitely a believer that history doesn't repeat, but it rhymes, and default rates will eventually rise and we'll see trouble in the market. Maybe that ends up working out a little differently going forward. That might not manifest itself in the public credit markets the way it has, but nonetheless, we're always watchful for it. I mean, all of us have been through situations where credits just get beaten down and things go wrong and people get scared, and you just know there's some panic selling, and all of a sudden you figure out how much conviction you have in that investment or not, and it's a painful lesson to learn, but once you learn it a couple times, you hopefully get a little quicker at making those decisions and understanding, when you want to put some capital to work when everyone else is truly being fearful.
Yeah. How did you work? I mean, as covering energy, how did you work through COVID? Looking at, I mean, the picture changed so much from April to October. I mean, how did you, to the extent you can remember,
Oh,
how do you go through a time like that and get back to
I can
normalized?
remember pretty well. That was really something else. I'll try and tell you the story chronologically, because in my nightmares, this is how it works. I was working. I should say, this is obviously told from my perspective, but at the time, as an analyst, and I don't think they can hear me from where I'm sitting in the office, so I'll go ahead and say it. I mean, I really couldn't have been working for better guys than particularly the two guys I was working for. Sukham Patel, who's not at the firm any longer. He retired a few years ago. Was really my mentor and first boss in energy. And John McLean, who is, even though he's a PM, is as an energy analyst, energy analyst, I'd put him up against anybody. Working for those two guys in that environment was, again, about as lucky as you can be to see how to work through that. So let's go back to January and February. I remember being at an oil conference. It was the last trip I took before COVID. And I think for everyone that took one last trip before COVID, you know where you were the last time you left your house. I was at an oil and gas conference. And this was right when Qasem Soleimani had just been killed. And there are Marines deploying to Saudi Arabia to counteract Iran. So we got a little bit of pop in the oil price, and that was the discussion point. Some of the headlines around COVID in China had come out, but whatever, we're in this sort of like the geopolitical risk premiums coming back into oil. And then COVID starts to come out. Okay, this is a problem. Okay, we know this is a little more widespread. What's going to happen? I think it's probably been forgotten because of how bad COVID was for everyone and how traumatic that experience was. Oil really fell off a cliff for the first time when the OPEC deal fell apart, which was a little bit before most people went into lockdown. And I can tell you, on that Saturday, when the pictures come out that the Russians and the Saudis have walked out of the OPEC room and they've knocked each other's flags over on the desk, and the Saudis have walked in and said, we're going to produce all out. I remember, 6:00 Sunday night, I was in the office looking at where oil's going to go, because I'm like, this is it. This is going to be bad. And it was. I think we were off $20 that morning. I mean, just an incredible move.
And that was appropriate. I mean, the market was getting that right. I think I was the first one in the office that morning out of mostly just panic. And one of our old PMs, the old shopper, was just a fantastic mentor and a guy that understood energy very well. I think saw me come into the kitchen and just laughed at me. Like, okay, welcome to the NFL, kid. This is what this looks like. And we huddled pretty quickly. I mean, we put every security that we could trade up on the wall and said, okay, here are our coverage lists. What do we want to do in this situation? Now, fortunately for us at the time, we had I won't say bearish, we'd had a really conservative view of oil prices. We thought there was enough production to go around. Early 2020, the discussion around discipline in the US, it had started. I mean, there were plenty of management teams saying, hey, we want to keep the capital out of the ground. Shareholders were starting to be very impatient with management about getting actual cash returns back. But it wasn't like it is now. And so we held some of the higher quality credits, much more fractured industry, not nearly as consolidated as it is today. I mean, it just, in some ways, it looked totally different. So fortunately, we were sort of on the sidelines from the really severe drawdowns on both the debt and the equity side. So that, from our perspective, things were ugly, but we were in a position to maneuver. And first thing we did was say, okay, how do we feel about OPEC and what they're going to do? That's bad. But then how do we feel about COVID? And so over the course of the next 2 weeks, the discussion shifted from there's a price war going on between Saudi and Russia to, okay, how bad is demand really going to get? So we went from a supply discussion to a demand discussion really quickly. We were cautious there in the beginning about putting too much money to work exactly for that reason. We thought the supply shock was serious, but the demand shock was even more serious. I mean, you could watch the tanker tracker from Saudi to the Gulf Coast of Texas and how much oil was going to be coming to the United States. I mean, it was that obvious at that point in time. So we were a little bit patient. And then, of course, we hit April and May, oil goes negative, and it looks like now producers are capitulating. Okay, we're throwing in the towel. Lay down the rigs. We can't keep doing this. OPEC understands, okay, this is the real deal. We're going to crash our budgets if we don't all kind of cooperate and get along here. All right, there's the bid under oil. Demand's still terrible, and we don't have the vaccines yet. So you have to look out 2 or 3 years to get back to a point that's tolerable. And the future strip is still reading $30, $40. So these are not exciting times. But on the other hand, you've got oil bonds that are trading at 30 and 40 cents in the dollar. And okay, we think we're getting paid for the price. That's when we started to put a lot of capital to work and say, okay, we think we understand these producers really well. They're still small. They're out of the way. If you're risk averse at all, you don't want to be in these credits. So that's when we started buying up some of the small shale producers that we thought would really be good tie-up candidates, really good consolidation candidates. And at the time in shale, you could literally just look at a map because the best synergies in shale really come from adjacency. If your property's right next to the other one, you can drill longer wells, you can get more out of your labor, you can get more out of your infrastructure. I mean, it really was that simple. Put the puzzle pieces together and take your ball and go home. And we probably had, I don't know, 10 or 15 names in the portfolio get taken out that way. I mean, the consolidation wave came and hit very strongly. And then in the back half of the year, and not that in no way do I want to take credit for calling that vaccines would work. I would hope they would, didn't really have a strong view. But then the vaccines came in. And of course, that really kicked off what ended up being a tremendous rally in everything energy. Because now that you've got production down and the price rally kicked off, it just ran for the next couple of years. And I'll make, this is a bit of a technical point, but I think one thing that's important to understand about that particular rally and the oil industry as it stands now, back to decline rates, shale wells are specifically U.S. shale wells, which is between the United States and Canada. We're really the shale producers in the world. They decline at such a rate that the market clearing price between supply and demand, the reaction function to that, so to speak, is probably much faster than it has been historically. So if you look at a conventional oil well, like they drill offshore, or they drill in the Middle East, the oil declines at mid to high single digits every year. You get that much less oil out of the well year over year. Back to the point around shale, it's more like 30 or 40%. So when you stop drilling in shale, people talk about the shale treadmill where these producers just have to keep drilling wells to keep their production up. If you stop drilling in shale, supply drops much faster than it has historically. So part of what happened in 2020 was you had shale contributing a much larger portion of overall global supply, so it could react a lot faster and supply could correct much quicker than the industry was maybe used to in past downturns. And that's one of the reasons that was such a short downturn in that sense. We had 9 months of prices being in the basement, and then starting that fall, they start to creep back up. A lot of that had to do with how reactive the shale producers could be. That still, to some extent, informs our view now of, all right, in a real price shock environment, how quickly can the market reach equilibrium? There's a natural shock absorber in the speed of the capital expenditure and the speed of the drilling, where we don't have to worry about plugging wells or abandoning wells or just turning them off. Naturally, the decline rate is going to bring that back into equilibrium.
Oh, because every year you're losing so much production.
Exactly. So that's a little bit what's behind we were relying on that a little bit going into the down market. And we think since it's probably been true. So anyway, yes, great learning experience. Really glad we could express some opinions there. Very exciting returns. I mean, I don't think I say this and then I'll be proven wrong tomorrow, but I would be surprised if in my career opportunities like that show up again, barring a true geopolitical event, just based on supply and demand. I mean, those are, if we got a once every 100-year pandemic, then that's probably about what you'll see on the demand side, would be my guess. But you got to dust off the Graham and Dodd at that point, because now you're really doing Mr. Market are we a voting machine or are we a weighing machine? And
yeah,
do you run outside with, if it's raining gold, do you run outside with a bucket? That's kind of the question you have to answer there. So yes, I know that's a very long way of answering your question of how do you feel about
I like it.
Oil in 2020, but we all got the scars from it, and I think it definitely helped us as a team. I think understand and see how people react and what kind of questions you want to answer, and how much trust each other, and can you rely on people to make decisions? How do you behave when things really, really get ugly?
Yeah.
So that was, I won't say
when it hits the fan.
That's it. Like, I wouldn't want to. I'm not going to sit here and say, "Oh, that was a blast. I'd like to do it again." I wouldn't, right? But I was still fairly early. I mean, I started my first year as an analyst was 2016, so this is 4 years in, and you're still a little bit used to it. I've been doing energy for 2 years at that point, and I still feel this. Up until that point, I had a deep, deep sense of insecurity about just not knowing what I'm doing, which was right. I'm convinced I was right about that. I didn't know what I was doing. And afterward, doesn't mean I still have that sense of paranoia. It's probably just my personality, but I'll never be comfortable doing it. But I have a distinct mental shift before and after of saying, okay, well, at least you can't tell me that I haven't been through a cycle before.
Yeah, that's right. Yeah. I've been through one of the craziest cycles.
Yeah.
Right? A once in 100-year cycle.
I haven't seen as much as most people, but I haven't, I'm not, I wasn't born yesterday either.
Yeah, no doubt. Is there anything that like is really interesting out there that's caught your eye? Are things pretty calm on the horizon?
I would characterize things as pretty calm on the horizon. I mean, to answer your question, it's been a while since there's anything where I would like bang the table and say, hey, we got to look at this. This is a really good opportunity. Things look fairly efficiently priced to me at this point. Yeah, if the Fed cuts rates, then that'll be a tailwind to every fixed income instrument, and that'll help. But we'll see.
How much does the front end impact that? Like, I had told you I was having a conversation with somebody, and their theory was that the front end is where all the issuance is, so that's what's actually priced, and the back end doesn't have as much price discovery in it right now. And I don't know if that's crazy talk or if that's reality.
I mean, that's a really good question. I don't deal at all in the long end, really. So I wouldn't want to give you an opinion on whether the price discovery there is good or not. I feel like I understand where the debate is, but I don't have a particularly strong view other than all the worries we all have as American citizens of, okay, well, if inflation doesn't come down and they can't lower rates or won't lower rates on the back of it, then what happens to the federal budget? Maybe that's a question I think we're all afraid of. But at the front, it's really a good question on the front end, particularly in high yield, because to your point, a lot of these credits will be refinanced or paid off in cash. And when you go to refinance, very few of these credits ever go current. They usually want to refinance more than a year in advance. So and that could be as much as a year or two. If you have, let's say you have two bonds outstanding, you get a 2-year bond and a 3-year bond, maybe you call them both at the same time. Granted, a lot of these bonds do have call protection, so you kind of know, you call it yield the worst or yield the outcome. When is the earliest this bond can get refied or taken away from you? So there's a little bit of a buffer there where it's not like, we're not exactly running tomorrow's interest rate or Fed funds into the yields. Having said that, loans have gone from being priced in LIBOR to SOFR, and that's a front end rate. So taking too long to answer your question of it's meaningful. I mean, it can have a really big impact, and it does directly flow into how we price all these instruments. Now, it has a fairly uniform flow. So from our perspective, it's a little easier to say, well, given where rates are, where should these other credits be relative? That's one question. And that does even move at the front end. But by the time you have a very short duration credit, whether or not it's right, a lot of the risk has been taken out. Less and less risk has been baked into that. So the spread tends to be a little narrower in there. So that's another,
that makes sense.
That mitigates it a little bit. You don't have to worry about, quite the same distribution of outcomes. So things do tighten up a little bit, and that spread will move it. But like you say, it'll move the whole market. I mean, no question about it. It does. It is very meaningful. I know mortgages and things like long duration instruments being priced off of, long duration government securities is obviously a well trodden and understood relationship. But even at the front end, it impacts us too. So part around valuation. I mean, I know that's a debate, right? If you get an earnings yield of 4% on the S&P and treasuries are paying 4%, then
the nice thing is the S&P can grow the earnings, right, where the treasuries can't. But
that's exactly right. That's the other point. It's not apples and oranges. That deserves to be repeated. But boy, it
doesn't seem like a time that there's a rain falling from the sky. But who knows? I don't know. It'll probably do what it's done historically in perpetuity, and with bumps and peaks and valleys.
Right. I mean, I would say, personally, my view has been, and maybe this is naive. I told this at a meeting where we were talking to some clients in Paris actually a couple months ago, and I was giving them this whole spiel, and I said, and they asked a very similar question. I said, look, at the end of the day, putting capital to work in the American capital markets has been the right thing to do at almost any point in time in the last 100 years, if you had a long enough time horizon. And and because of that, I'm still, I'm always an optimist given enough time. And and the guy looked at me and laughed, and he said, "Yeah, that's because you're an American." Which coming from a French, and he wasn't trying to insult me. Coming from a Frenchman, it was pretty funny.
No, I know.
Because in a lot of places, that just isn't true. But in the U.S. market, it's been true, and I think it pays to be paranoid. I think it is worth worrying about. I mean, I think part of our job is to worry about whether that's not true going forward. But be that as it may, I think it probably will be. So over the long run, we're still thrilled to be able to invest into this market. And it's like Buffett says, being an American investor has been just the greatest wealth creating tailwind anybody could ask for. And I don't think that's changed. I know that's sort of the debate of the day, but I'm still thrilled to get the opportunities we get. Are they wildly obvious at the moment? I would say probably not. Was there anything that I think is an imminent massive return? I don't know. I haven't found anything that I'm that excited about, but I feel as though I found plenty of things that if you give me the chance to look out several years, I think are going to be quite satisfactory. And that's my time horizon. Now, it's easy for a young guy to say, so I've got time on my side. But Charlie, Munger likes to say most of the money's made in the waiting. And that probably is still going to be the case.
Well, if you're buying long duration assets and you're thinking short, you got a mismatch. If I've learned anything, that's what
That
I've
is
learned.
that is well said. Very well said.
Yeah.
The,
So
the old
cool, man. Well, listen, I appreciate you coming on the program, and I hope that you've enjoyed it, and I hope that we stay in touch. I've enjoyed the pre-work on this
Hey, well,
one.
go likewise. Thanks for letting me bounce around here and talk. It's funny. I get to talk to John, Bill, and Jack all the time, but it is really you said, hey, don't, these are obvious questions. No, it's great. I hardly ever get to vocalize my opinions to a outside third party, and it makes you, talking makes you think better. So,
Yeah, I think that's right. Writing too.
absolutely, absolutely. So no, please, I appreciate you taking the time and reaching out. It's been great getting to know you a little bit. And, obviously, don't hesitate at any point going forward. Love to do it again, or even if some security comes up and it's offline, you just want to ping me about something I'm associated with. Hey, don't be a stranger.
Well, be careful what you ask for on that. There may be some inbounds.
Hey, no, I'm here for it. I'm here for it.
All right, sounds good.
Hey, thanks, Bill. I appreciate it.
All right, have a good one.
Thank you. You too.